Hello YouTube, this is Stephen with On My Way to Fire, a channel about early retirement, all things investing, personal finance. And so in today's video, I want to talk taxes. And just to get right into it, I am not a tax professional, not a tax attorney, not giving advice any way, shape, or form, just giving some information on what my situation is like and how I've adjusted. So I wanted to do a look back here for my working career at my current company. In the year 2012, California standard deduction was $38.41, and in 2026 the standard deduction is now $57.47. And although it's increased, it really has not kept pace with how federal tax is treated. So in 2012, federal tax standard deduction was $59.50, and it now stands at $16,100 for the 2026 filing, which is insane that it's gone up so much. And I think with the situation that we have right now with the inflation being so rampant, cost of goods is very expensive right now. You look back to 2020 to date, the rate of inflation is probably somewhere around 30% if you compound it. We do actually get a little bit of a break on our federal taxes thanks to this huge increase in the standard deduction. And I think we don't really appreciate it because we don't see it up front. We only see it when we file our taxes. And it's kind of like you're settling up a debt. And so you get a slightly higher tax refund or you owe slightly less thanks to this amount being increased to over $16,000 for a single filer. So I want to put this in perspective and share some strategies and how I'm approaching it for this current year. So with that in mind, the reason why the standard deduction went up so much was in 2018, we had the Tax Cuts and Jobs Act passed in 2017. And that nearly doubled the standard deduction at that time from $63.50 in 2017 to $12,000. But as we've seen from 2018 at that $12,000, we've now gone up another $4,100 to the current. So, that's a huge benefit. The other reason why is the big beautiful bill made some of this tax changes permanent and kept the brackets lower. And so, in doing some research for this, my main objective really is to continue to earn qualified dividend income. And let's get into what that is. That's treated at a long-term capital gains rate on your federal taxes. And that's because the corporations already paid a tax, and policymakers that make these laws, they want to encourage long-term investing. So the qualified dividend rates are 0%, 15%, and 20%. And how this is going to be determined is at the end of the year, you're going to get a 1099 form called a 1099 div, and that's going to give you the details. And the big difference is in California, they treat all income from dividends as ordinary income. They don't care if it's qualified dividends. So the reason why I'm paying a lot of taxes in California for the state tax is because number one, the bracket is only $5,700, and there's almost an $11,000 difference between the federal standard deduction versus the state. Then on top of that, I don't get the preferential tax treatment on the qualified dividends. So it's definitely a bummer, but it's kind of the cost of admission for doing the investing game. So that's just how it is. If I had a second job, I'd be subject to FICA taxes for Social Security, Medicare, and disability. And that's probably going to be somewhere around 8% if you add all that together. So dividend income is actually pretty powerful because you're not getting that 8% hit on it, but you are going to have to settle your taxes at the end of the year based off how much you make. So with all that in mind, on the federal side, let's focus on that right now. With qualified dividends, if I can get to the 12% bracket, which is $48,475, that's the top. So you want to leave margin to get to that number. And so basically my goal is to stay between 42 and 44,000 and have that margin so that my dividend income can make up that difference. And if I do it right, I can get 0% tax paid on the federal side for that dividend income. And if I go over that, that's okay. It's only going to get taxed at 15% or 20% depending on how high I go. I don't earn enough income to be into the 20% capital gain bracket, but I might have a portion in the 15% bracket if I earn too much in capital gains and qualified dividend income. Okay, so what does this all mean? This means that I get to keep more money and I'm more tax efficient. And so my big goal for this next year in 2026 is to really evaluate what exactly I'm holding in taxable brokerage accounts. This is where it's pushing my income up too high due to closed-end funds and other dividend funds that are just paying too much in dividends, and it's pushing me over the top. So the way I kind of took a look at what's good, what's performing, what's not, I have a few closed-end funds that haven't been doing very well. And one of them actually came back. And so I was purchasing shares in this BlackRock closed-end fund up until February through March. And I actually have a decent-sized little comeback there of between 25 and 35% on some of those shares. But because it's so recent, they would be short-term gains as far as my federal tax would be concerned. Again, in California, they don't care. Short-term capital gain, they're just looking at ordinary income on the gains as well as the dividends. So my solution here would be to sell everything that I had that's at least a year old. And if I did that, I would actually squeak out a small gain around $200, but I'd return over $8,000 to my brokerage account. And I could choose to move some of that to my Roth IRA and pay off my home equity loan. I think that would actually be the best approach. If I did this, I could get the minimum payment on the HELOC down over $30 a month and put somewhere between $800 and $1,000 in my Roth IRA, and then leave a small buffer of cash in my checking account. And that would give me some options later. And I think that's probably the best approach for that particular fund. And so, of course, today I'm kind of getting ready to do this, and that fund is down, a fair amount to where I'm like, great, I should have done it yesterday. But that's how these things go. I had been selling some shares on the way up, so I did capture some gains a little bit here and there on some shares, but I have a bulk of it still. And most of it is over a year, so I think that's my best approach there. Now, I have another dividend fund through Global X, and that performance has been very poor. I'd be taking a loss around 30 to 33% if I sold all of it. And similar to the BlackRock fund, I was buying a few shares within this last year, so those would be short-term gains. So I did an evaluation on this, and as far as taxes go, I could get what's called harvesting a taxable loss. And I would take a loss on that fund. It'd be over 30%. It hurts to push that sell button and do it. But let's take into consideration what I benefited from by having this fund. So every month I get a dividend, and it's paid me approximately 5.75% based off my cost basis. But the dividend was cut in 2020 right after COVID. And that definitely hurt because the stock price dropped and it never recovered the way it was before that. And because the dividend never came back, my yield is kind of low compared to where I could be if I purchased that fund now. So let's figure though, being in that fund for about 8.5 years, that's quite a few dividends. And even at that rate, we'll just estimate that I got somewhere around 42 to 45% as far as dividend return. But I had to pay taxes on that year after year. I am electing to receive that as cash in the brokerage account. So I used some of that money to pay bills. I used it in past years to get to the Roth maximum. So all in all, I probably made money on it because I've got somewhere around a 40-some% return on the dividend. But essentially it was dead money. It didn't really do much for me because I had to pay taxes yearly, and the fund itself is going to be sold at a loss. But what I can do is I can apply that capital loss to my taxes, and that would be a pretty good deduction to have on this next year. And depending on how I file and how much gains I have, I might be able to carry that loss into the next year. So sometimes you win, sometimes you lose. My average is usually around a 90 to 95% success rate. So this is going to be in that 5 to 10% where it didn't really work out the way it could have, but at the same time, it's not a total loss. So I think that's the best approach to do that. And again, I could take the proceeds from that, put a little bit in the Roth, and put a rest on the HELOC, and I could save another $25 to $35 depending on how much I want to put on the HELOC. And lastly, I have an oil stock that's performed really well in this last year. And what I did was I sold shares at the highest cost basis to at least get some slight profit on it, but keep a bulk of it. So at one point I had about 110 shares, and now I'm down to 80. And so what that's going to do is that's going to lower the amount of dividends from that stock. And, I can deploy that money elsewhere. So I put part of it in my Roth, used part of it to pay bills on the 20-some shares that I sold. But I still have those 80 shares, and I'm sitting at like a 45 to 60% gain on those shares. But if I sell them, I'm going to be subject to California tax and long-term capital gain on my federal tax. So I'm still debating. I think that stock still has room to run. So it may not be best to sell it. It may actually go down from here, but I'd be okay with it. I could rebuy shares in my Roth and trade it from that point and just make the difference. So it's all in the approach, planning ahead, and having a game plan with how I want to tackle all these things. Now, if all this was in a retirement account, I can make the moves quicker and not have to be so deliberate about doing them. But it's kind of frustrating when you're trying to manage your own money. You have to weigh the pros and cons and see what's best for your actual situation. And so what I've calculated is that I think in 2025, if you had taxable income around $48,350, and your dividends were included in that, you would have qualified dividends at a 0% rate if you did it right within that bracket. This year it might be around $50,400. So it is adjusted per year based off your taxes. And I would recommend you running your information possibly through ChatGPT, checking some tax tables, and doing some estimates based off what you made last year and your projections for this year. So I'm going to have a lot of topics on my channel this year, but one of the big factors for getting that taxable income down is contributing to a 401k. So if you have W-2 wage income like me and you're a single filer, I don't have anybody to deduct other than myself. I don't have dependents. So I have to do whatever I can to get that taxable income down. So 401k contributions are tax deferred, so it comes right off the top. Then you have your healthcare premiums, and possibly if you participate in a health savings plan for high deductible health insurance, that also comes off the top. So I do whatever I can to get that taxable income down as far as possible. And if needed, I actually run a shortage on my month-to-month bills based off my income. And my paycheck does not cover all my bills anymore because I'm putting 40% in my retirement account pre-tax, 15% in a workplace savings account for an employee-sponsored stock plan at 15% post-tax. That one hurts. And then the health savings account, I'm putting about $25 to $30. I'd have to look at the number. But my company offers a match on the health savings plan as well. So I'm doing all this finagling, rotating, doing what I can to have money in different places. And I use the dividend income coming from my taxable portfolio to bridge me through and get me through the month on any shortages. And then when I have a great year like this year where I've been able to sell some stocks, I can sell at capital gains rates and harvest those gains, move money into the Roth, and have a little bit of a cash cushion in my checking account. So that's kind of what I'm doing here. So I'd love to hear your comments on this approach. If you're doing something similar, if you think I'm crazy, whatever you want to comment, I'd really appreciate it. Trying to get this channel going with more viewer engagement. And with that said, we'll see you in the next video. Thanks.